everyone. How's it going? Welcome to Twin Cities Startup Week. I'm Ryan Broshar with Matchstick Ventures, and I got my partner here, Natty Zola, as well. And we're excited to do our fundraising AMA with us. So the intent of this session is really an open conversation. We'll be taking questions from the chat on the side here. So please, be putting your questions into there. We'll be asking each other some questions as well. And we just hope to have an open conversation with, anyone in the audience here. So there's no dumb questions. We're happy to go into as much detail or, as layman's terms as possible, or, go down deep rabbit holes. You let us know. Yeah, feel free to, add some of the questions into the chat here, and we'll be monitoring it as we go. So,
and should we have people put questions maybe in the session one? I think that's just for this session.
Oh, yeah.
And the event one might be for the whole event. So you can throw your questions wherever. We'll be monitoring both, but I think the session one will be just for this group, for anyone who wants.
Yep. Awesome. Cool. Well, maybe we'll just start with like a quick intro of each other and Matchstick.
Right. Like why should we be talking about VC funding?
Yeah. Who are these guys?
Sure.
Yeah.
Cool. So I'm Natty, and I was a founder first. So I started a company called Everlater back in 2008, and I raised 2 rounds of venture financing. So I've raised as an entrepreneur, and then I ended up selling that company to AOL 4 years later. And I saw a lot of ups and downs. I was lucky to work with great investors. And so I've sort of was influenced by the venture capital path early on because I had great folks to work with. And then I didn't expect to become a VC, but I ended up working for Techstars and running the accelerator in Boulder. And through that role, I learned that I loved working with entrepreneurs, and I was more passionate about helping other people achieve their dreams than me chasing my own. And I was providing a lot of feedback and help for entrepreneurs, and they said, oh, it'd be great if you also had some money in addition to the connections and expertise that I was sharing. And was lucky to work at Techstars and get a chance to try doing that, and then teamed up with Ryan at Matchstick. And now I've invested in about 110 companies in the last 6 years. And together, Ryan and I have deployed almost 100 million, or haven't deployed, but have raised and are in the process of deploying $100 million as VCs. So I've seen it from both sides of the table, having raised VC and now deploying capital as a VC. So I think I have enough experience now to kind of know what I'm doing, but I'm learning every day. And I'm excited to share that experience with you all to hopefully help you better understand VC, determine if it's right for your business, understand the nuance, and ultimately at the end of the day, just get smarter.
Yeah, right on. So I mentioned I'm Ryan Broshar with Matchstick. I'm based here in the Twin Cities. This is an exciting week for me. My background is I was an entrepreneur first, similar to Natty, and also started Matchstick in 2015 with our first fund, and then actually started Techstars here in the Twin Cities as a former managing director for the Techstars retail program for 3 years. I'm also the co-founder of Beta here locally and of Twin City Startup Week. So pretty awesome to see how much this has grown and taken off. So very exciting for us to be here. So yeah, so similarly to Natty, made quite a few investments over the years. He mentioned how much we're deploying. We just announced our new Fund 3 last week, which is a $55 million fund that we're investing in pre-seed and seed stage startups in the Rockies and North region. So yeah, very excited to jump in here to any questions folks have. So I put a little chat starter here on the right in the chat, or you can do it via, I guess, Q&A as well. But if anyone has any questions, feel free to type it, into the chat here. Otherwise, we'll just keep
Is this a person
talking.
who wants to ask a question here? Maybe live?
So maybe. Well, we'll
start with this one.
Yeah.
Cool. So Ryan, this is a question from Allison.
Okay.
I feel like we're on some hotline here.
All right.
When you provide feedback to a startup before investing, how important is it that they follow your requests to the letter?
Ooh, that's a good question. Well, I think you and I talk about this quite a bit, but I think no one knows your startup better than you, right? Like you're the expert. that the founders are the ones who actually know, what is probably the best path forward for the founders. And we're just here to learn and then, be able to support that if we believe in that as well. So you'll see a lot of investors may say like, oh, if you only had, X amount of revenue, or if you had this many customers or clients, then I would invest, and I don't really believe in that. I think everyone, there's, especially at the earlier stages, it's much more qualitative than quantitative in those evaluations and those kind of like arbitrary milestones, if they're thrown out. I don't think really mean much to that investor, because if you actually went out and hit those numbers, does that mean that they're immediately going to invest? It's probably not, right? Like it's probably more of like they're just general not interested in investing. So the feedback, I think it's always an opportunity to learn about your business in the fundraising and get the feedback of maybe like what maybe the market is saying, or maybe you can learn something from investors if they've seen something similar. But I don't think it's that the founder has to follow that, and that investment strategy or not the investment strategy, but the advice given to them by VCs. I'd much rather people take advice from their customers and build product based off of that.
Yeah, I remember someone told me this, that one way you can think about meeting with going to be experts in understanding like what's fundable and what they're seeing out in the market in terms of benchmarks. And so I would just look at it as interesting data and take that as into consideration when you're building your plan, and know, okay, this might be what investors are looking for, is like this level of growth or this level of traction, but you want to get a lot of data points and then figure out what, like Ryan said, what the right path for you is. And you can even, we think it's healthy for you to push back with an entrepreneur and say, oh, or ask questions, say like, why is that important to you? Or what, let's say we hit $1 million in revenue. Like, why is that an important metric for you? And you can start to learn some of their thinking and get some of the context from them, but then ultimately choose your own path, because you're not building the business for investors, you're building it for customers.
Yep. Right on. Should we try one of these?
Yeah, let's try it. All right, we're going to bring someone up here on stage.
Let's see, Shia Hart. Let's see if we can get you on here. Is this going to work? Hello. Maybe David.
I don't know if that works. Let's try David here.
All right. If not, maybe we'll just go. There we go.
Oh, we got both of you. Cool. All right.
David, you there?
Yeah. Hi. Thank you.
Yeah.
Just typing the question. It's basically around the sense of a lot of VC firms have left Silicon Valley last year. Great to see how many cities are kind of re-emerging as new places where venture capital work is happening. Curious what your sense is in Minnesota compared to other places around. It's not really been known to be a hotbed of venture capital in the East Coast, West Coast, sort of universe, but it's emerging. So can you chat a little bit about that?
Yeah, sure.
Good one for you, Ryan.
Yeah, all right, cool. And happy to answer that for you, Dave. So yeah, it's been pretty fascinating, honestly. When we started Matchstick in 2015, there was little to no seed stage, definitely pre-seed capital in the market. And if you wanted to raise like a large round, you were forced to go to the coast or to larger markets. We're seeing a complete kind of flip of that more recently, to be honest. Like we've seen just like the great influx of entrepreneurs, great companies that can compete with anyone around the world. In addition, you're seeing coastal VCs much more willing and interested to invest out of their market. I think COVID was a massive multiplier on that, because if you can invest via Zoom, you can invest really anywhere. And you're seeing people trying to find alpha, in the markets, right? Because if everything's kind of concentrated all in one area, then that kind of everything kind of goes to the means or the mean on the return. So if they can find some, differentiation out there, they're willing to do that. And luckily, I think the Twin Cities market in particular, I'll speak on that behalf. Like we are regularly seeing large coastal VC funds reaching out to Matchstick, asking about companies and making investments, in our companies here. So, we've had some pretty big rounds recently from tier one, coastal VCs into our portfolio and other startups, in the market. So there's data to show around it too. If you look, I don't have it in front of me, but just like the amount of, capital coming into the market, which we think is a net very positive indicator of interest. Because the vast majority of venture capital is still coastal, but you're starting to see their willingness to invest, in non-coastal markets, especially in Minnesota.
Great, thank you.
Yeah, awesome. Let's see. All right, should we go back to some of these questions here?
Great.
Yeah. All right. Darren's got a question for us. Hey, Darren. For a B2B SaaS startup, what MRR and monthly growth rate values should founders target to raise a successful seed round in the Midwest? Well, I would say this is probably pretty similar between Colorado or Minnesota. You want to take this one?
Sure, yeah. Well, I think the goalposts are frequently changing here, and your results may vary. So I can share kind of what we're seeing probably maybe as an average in the market, but we're also seeing outliers on both ends. So we're seeing some companies that have a lot of revenue struggle to raise money, and we're seeing companies that have no revenue easily raise money. So
it's too much money.
Right. Yeah. So I think unfortunately it's a frothy market right now, and there's sort of no standardization, and each investor is their own unique snowflake of what is important to them and what they're looking for in a company. But I would say let's break down some of the questions here, just because we don't know how much experience everyone on the call has. So for a B2B SaaS company, so this is like a pure play software company that's selling a product to other businesses. MRR meaning what's the monthly recurring revenue that they're getting from that subscription model, and what is the growth rate for a seed round. So maybe the other thing to unpack in here is what's a seed round these days. And so that's something that's also been changing. A seed round these days in the Midwest, I would say, is probably about a $2 to $3 million fundraise on a company that has some product market fit or a product in market, so there is some revenue. That used to be maybe what we would call a pre-seed round, but pre-seed rounds have now gone a little bit earlier. So that could be more at the idea stage or trying to build out a product. And maybe that's more of a $500,000 to $1.5 million round. So if we're focusing on a seed round here, which means a company that has a little bit more traction or progress than the earliest stages, I would say for a successful seed round here, you're probably looking at maybe 10 to 50K in monthly recurring revenue is when you're starting to see those seed rounds of 2 to 3 million coming together. And that's a point where investors feel okay, this company has a product that they can sell. There's some customers that we can talk to as investors. We can start to extrapolate on what the value of the product to those customers may be. And some of the feasibility question around the company, can this product be built, is a little bit de-risked. But the question there is much more around what's the market size. And so I would say maybe in the 10 to 50K monthly recurring revenue is when you're starting to see a successful seed round come together more easily. Not saying it's going to be easy, but a little bit more easily.
Yeah. And as far as growth rates go, on that, you'll have to have some sort of path or projections or pipeline to show the growth rates of probably about 100% year over year. So you package that down into monthly, so it's 10 to 20%, month over month. And I think if you have those kind of consistent stuff, that stuff starts to compound, and you have to show that. So I do think growth rates are really important at this stage, because you're really trying to demonstrate momentum, right? If it took you 6 years to get to $1 million of revenue, that's not as exciting as taking a couple months to get there. And so it's less about the arbitrary milestone of the actual revenue amount and more about the kind of momentum of the company. That's when VCs start to salivate and get really excited, is when they know that there's already a fire going, and they can just throw some gas on that fire and keep it going.
Yeah.
Let's see.
All right. I'll ask this one from Jeff here. This may be difficult to quantify. How much stock do you put in financial projections, Ryan?
Okay. Good question. So I would say it's less about the outcome of the financial projections and more about the inputs of the financial projections, especially pre-seed. Who knows, right? You kind of have finger in the air, hopefully that, you know, you can say like, hey, this is our path to becoming $1 billion company. Like, okay.
That's much more like smart team in an interesting market.
Exactly.
But the financial projections are, to your point, the financial projections are interesting because you're like, oh, this is how it's more of a representation of how they're thinking about the business, not the actual numbers coming out of it. Yeah.
Yeah. And I think once you get into seed and you start to have some revenue or product, like, right, then you should really start to have a sound model around how you make the money, right? And you want to have good inputs. And I think most VCs are looking at the inputs to be like, how are you thinking about this? Like, what are the levers in your business that must be true in order for you to grow revenue? And if you do that time and time again, then they start to think through like, what could this become based on the market opportunity set you're going after? So I don't think it's like, oh, we have, you know, projections of, you know, 500K and then 2 million, you know, it's like, it's easy to crank out a model that shows you, you know, doubling, you know, revenue every single year. It's a lot harder to have a model that shows you doubling revenue every year with very sound inputs that when challenged, you know, you can defend and say, no, this is why this is the case, or this is why we think this. So more times than not, it's a thought exercise about the inputs than the actual outcomes of the projections.
I have a follow-up question for you that's sort of unrelated, Ryan, here, but just for fun.
Bring it on.
Does pineapple belong on a pizza?
Oh, yeah.
I agree.
Absolutely.
Okay.
I mean,
no debate on this.
Actually, I think Hawaiian pizza is my favorite pizza. And if you can get like a spicy Hawaiian, I don't know who makes it.
Pretty
I think
good.
Pizza Luce in town here is like pretty good stuff.
I noticed that in the polls section on the right here. So I thought we'd just of maybe on like a fund strategy versus a strategy for a startup considering raising VC, but we're happy to answer any questions.
Yeah. Reminds me of that song, like, I wish that what I know now when I was younger.
Totally. I would have been a lot cooler in high school.
Yeah, no, yeah, and invest in Bitcoin. Probably.
I would have a lot more Bitcoin.
Yeah, definitely.
Well, actually, when we were that, you know, young, I probably would have. It wasn't Bitcoin. It was like buy Apple.
Yeah, yeah, it's true. Yeah, buy Amazon Apple stock. Anyway, so I think when at least I'll speak on my end, and you can speak on your end too, of like when you started making investments. But I think when you first get started in VC, and this is my end, is what I tended to do is get much too obsessed about the product, right? And being like, oh, that's a cool product, and you know, man, that'd be fun, and then projecting it onto me as the customer, right? And being like, I would use that. That's cool, you know, versus what we look at today, which is a couple of rules of thumb, like, you know, founders is number one, first and foremost, like evaluating the founders and characteristics of that founder. And then the market, you know, like how big of a market opportunity you're going after. And really product is like, I don't know, maybe fourth or fifth on our list of things that, like, you know, we really weigh in on. So probably like much too much emphasis, you know, on product and not enough evaluation on founder and, you know, market potential. I think another thing that we've learned over the years is there's a difference from like a fund strategy when we invest to, like, you know, great companies doing great things that are going to be awesome versus, you know, great investment opportunities from Matchstick, and just getting kind of more and more disciplined around like what is a Matchstick deal, and, you know, what are the characteristics of that to make sure we're, you know, making the best investments, you know, for our founders. So I don't know, those are the two off my head. Yeah.
I think the one I would add, and this is also one relevant for startups, is I think it's like trusting yourself more. Like I think, and maybe this is, I have an extra bias for this, but I get value from external recognition, and it was like fun and exciting for me to be in, I don't know, invest in companies that other people are excited about. And I just think like I didn't trust myself enough and kind of went with the crowd versus just kind of doing my own work and doing the things that I believe in. And I think that you can't go wrong ever, you know, believing in the things that you believe in and getting your own conviction and doing your own work. And I mean, honestly, that's why most entrepreneurs do their thing, is they want to go and do something their way. And I think early on in the fund process, like I sort of cared too much what other people thought, for what it's worth. So
FOMO is real.
FOMO is real.
Yeah. It's so real.
Cool. Let's see. I think we have some other great questions in here. This one's from Patrick. So could you share some thoughts on when or how to raise a pre-seed round? Maybe I'll take this one.
Yeah, go for it.
So pre-seed round, usually like today, is more on the like idea. I have an idea, maybe I'm starting working on it. It's like relatively early in the process. Usually pre-revenue, but doesn't necessarily have to be pre-revenue. And typically is a fundraise that's around maybe $500,000 to $1.5 million. And so the goal of a pre-seed round is to really prove out that you can build the product, one, and two, that there's like early customer interest in it. And so I would say the time to do that is, well, generally my thought is that you should always wait as long as possible to raise each round of funding, because it gives you more and more time to generate progress and proof points, which ends up giving you more leverage in that fundraising process. So what I would say is like, it's somewhat of a personal question, because it's a question of how long does your personal runway last? How much of your personal runway are you willing to put in it? How much of the product can you build without having capital? And so as you start to answer those questions, that'll give you some clarity around when to do it. But in general, I think it's good to wait as long as possible and then do it, when you need to, when you have some of those proof points, and go figure it out. And in terms of how to do it, so unfortunately, the fundraising market is still relatively like hard to get access to. Lots of us are trying to work to make that easier. There's things like AngelList. There's VCs in the last 5 to 10 years have become way more accessible. They've had to compete more for deals. You have folks like us just trying to be out and involved in the community. We want to meet as many people as we can. So really what I'd say is it's getting easier. It's not easy, but you want to just put yourself out there, go to meetups, go do research, hang out on AngelList, find people who have invested in similar startups, go to, find people and ask them other startups and ask to get intro to their investors. And so what you really want to do is start to build that network around your company, and unfortunately still sort of just like network your way through things. We hope to be super accessible, so you can reach out to us and we can help make some connections for you as well. But it is still somewhat of a relationship experience. And we know that like disadvantages like large populations who don't have built-in networks, but those networks are starting to get somewhat dismantled, which we think is a good thing.
Yeah. So
I don't know if you want to add anything.
I mean, I think the other path to pre-seed is probably via accelerators, right? Because I mean, basically an accelerator round is more times than not, you're at like a pre-seed stage, or maybe kind of like going into a seed round. In our background with Techstars, we had many companies that were, maybe toiling with a new product or tinkering with something. And, I think accelerators can be, great pre-seed round options, because there's the network and the value add at that level is pretty profound if you get into the right ones. We clearly drink a lot of the Techstars Kool-Aid, but there's really great accelerators across the board, either YC nationally or, here locally with Generator and some other corporate accelerators. So anyways, I think it's another route to raising a pre-seed round.
Let's, we have a few folks who want to come up on stage here. Let's shift from the text questions. We bring up Munachiso. I hope I pronounced that close to right. And please let me know
this works.
How to do it. Let's see if you get up here. Maybe while we're doing that, I'm going to bring up Patrick also, and we will get to the questions in the chat as well. Don't worry, we're not going to lose that.
Looks like we got Patrick. Hey, man.
Okay,
hey.
Patrick came up. All right, Patrick, what question do you have?
Yeah, I was going to ask a follow-up to the one I just asked. It's kind of, I've never done like the actual on-stage thing here. It's kind of
I know, right?
Long-time listener, first-time caller.
Just showing up. Yeah. Exactly.
It's kind of weird having you guys respond to my question. I'm just kind of like this faceless entity. But anyways, the follow-up question I was going to ask was from another pre-seed thing that you touched on previously, saying that it's a lot more about founder fit or founder market fit, et cetera. But one of the things I've been kind of unsure of is how to convey that in some of these early questions. Like I know, some angels I've spoken with will have like, 6 things we look for, et cetera, and they're very qualitative, like coachability, integrity, all of these things. That's like, I don't really know how to bring that across in a 20-minute conversation, you know, and still talk about the product and things like that. I think as like a technical founder, especially, I'm much more focused on like the product and a little more removed from that side of things. So.
Yeah. Well, I do think like early stage startups, like let's say pre-seed or seed, like there is a need to be able for storytelling, right? And being able to say kind of like, hey, look, this is the company we're starting. This is, and I think a lot of it is the why, right? Like why this company, why you, why now, you know, like there's just so much to unpack there, right? And if you can make a strong case of being like, hey, look, this is a story, and then be able to project out the vision, right? And that's all kind of part of that initial story. And you know, it's harder to do if you're, you know, say introverted or you know, versus extroverted, or there's different characteristics there. But I do think, you know, the ability to say, for someone to say, yeah, I want to, you know, invest in this company, you still have to be able to explain to them the kind of the why behind it. So I would just, you know, make sure you have like kind of a, you know, really tight story around that. And then clearly if that VC has like characteristics of that stuff that they look for, be able to tie that, you know, kind of into your story, like what, you know, why you, why now, why this company, you know, stuff like that they might be looking for. So you mean ultimately a lot of that stuff is, it's not like you have to like check every single box and they're like, cool, you check the boxes, like here's the investment. You know, it's much more about just like, hey, here are common characteristics, if you will, or things that we've seen succeed previously. I don't think it's like a has to do all, you know, has to have all these things or not, but you'll probably be able to incorporate that into your story somehow.
I will also say, I think like, especially at the pre-seed stage, like these are investments people are making based on a connection with the founder or founders. And so it is a lot about the relationship. So think about it as go into each of those meetings, being genuinely curious about meeting that person and getting to know them as well. And that will actually go a long way. Like one of our mentors, basically his advice to us when we were raising our fund, because we have to raise money just like a startup does, was he said, don't pitch the pitch deck. Like go in and build a relationship with that person. Like they're going to invest in you because they like you, they want to see you succeed, they get to know you. And I think when in our fundraising processes, we rarely actually like pitch from our pitch deck. We know our story super well and we're ready at any moment to like flip to it if they ask a question, but we really go in trying to build a relationship, make sure they understand our why, understand like what's unique about us, but really build a relationship. And so maybe think about it as like a multi-turn experience where you actually, your goal in the meeting is not to get an investment. Your goal is to get another meeting. And the goal in that meeting is to get another meeting. So because that gives you more time to build a relationship with them, which will ultimately lead to an investment. Obviously, at some point you need to make the ask. Like you don't want to have, you know, meeting number 20 and you're like, all right, what are we doing here? Like, are we friends now? Or are we like, exactly. You know, what's happening? But I mean, dating analogies are usually pretty good for this too, is like at some point you need to go in for the kiss. And, but you know, you also want to build a relationship before you go straight in for the kiss. So
the Zoom kiss.
Yep.
Zoom kiss.
I have a question for you guys.
Yeah, great.
Yeah, see Patrick.
Thanks, Patrick.
My question is this: as a when you're building your product, like for instance, my product, I built it, self-funded it, and tested, tried to see if there was a product market fit for me. When then should I decide to go into like pre-seed fundraising or seed fundraising?
Yeah. Well, I mean, I think that's more times than not when you choose to go and raise fundraising is because you see an opportunity that you otherwise wouldn't be able to do without that capital today, right? Like you may be able to bootstrap the company and like get the revenue and be able to grow it, you know, under that. And sometimes you can grow really quickly on that, depending on the business. But, you know, more times than not, the bootstrapping is a little bit longer. And sometimes there's a timing aspect to it, right? Where you're like, hey, if I had $500K, $1 million, $3 million, like these are all the things I could go do tomorrow because of that capital. And that then is like the window of opportunity that I want to go and jump on, right? And I think, you know, startups especially are just moving at such a fast pace. There's so many new ones all the time like there is a need for speed sometimes when it comes to growing your company, and think of that, the capital, as, you know, an accelerant on there. I don't think you should raise capital just to raise capital, right? Like that you should have like a real purpose and need behind it. And if you have it and that matches with, you know, potential growth, that's really the sweet spot for venture capital.
So what metrics do like the VCs look for when like a startup like mine approaches them and say, okay, this is where we are at our growth, and right now we need capital to accelerate our growth because it's a speed thing for us. It's now, like, we need to get into the market now. If not, another bigger company with bigger horses can, you know, overshadow us in that market. What metrics should we be presenting to those VCs?
Yeah, I mean, I think this is a little bit of what we talked about a little bit earlier. You know, I think a lot of it is about where you are today and, you know, where you plan to get to with the capital, right? And that could be around revenue, that could be around a number of employees, number of customers, product features, you know, and you got to think about the fundraisers around, you know, achieving certain milestones, and then saying, like, if we achieve this, so what? Like, what does that then lead to? Like, you know, kind of paint the bigger picture of like where you're headed as a whole company. So I wouldn't say there's like a hard and fast like metric you need to get to. I think it depends on your business and where you're going, but you just want to show momentum, right? Like showing that, you know, this is where we are today and we're going to be growing and growing off of that and off of that. And let me show you like how this capital is going to enable us. So yeah, sorry, I don't have like a hard and fast, like, you know, here are the metrics. There's common ones, you know, out there, but I think it, you know, it would really depend on your specific business of that. And to be frank, like, I think that's part of the education that the entrepreneur can provide to the investor too, being like, hey, here are the things that we care about, you know, and let me tell you why. And that's a good way to build rapport and trust with an investor, to say, like, these are the things we're tracking, and this is why we're tracking them, and you know, they're growing, or, you know, whatever, and we want them to grow more with the capital.
I had one thing to build on that. I do think, like, for your first round of capital, you either are raising money based on the quality of the team and the insight, which is hard, but you can do that, or you're raising based on the stickiness of the users and the product. So I think, like, all being equal, like, if I had to say, what's the one metric to go out and raise on, or really to focus on, is you want to show up to an investor and say, our customers love our product. And as evidenced by whatever makes sense for you, like, you know, is it recurring revenue and we have no churn? Or is it every customer buys and comes back and repurchases from us every 23.2 days? Or users use us on average 4 times a month, and over the last 3 months, they're now using us 7 times a month or something. Like, what you want to show up is say, not only do I have a great idea, but I can prove it because our early users and our early customers are so happy that they continue to use it. So that could be like whatever it is around retention. And what you're actually proving here is the value hypothesis. So in most startups, there's 2 questions. There's the value hypothesis, which is, are you building something people want? Does it solve a problem for them? Is it adding value in your life? And that's where I think you should start. And that is usually around like repeat usage or stickiness. And then the second is around growth hypothesis, which is the question, like, can you acquire customers cheaply, and how many customers are there out there? Usually startups like think they know that when they go and pitch investors, but actually you don't really find that out for years, but you can show up with a good sense of like the value hypothesis proved out.
All right. Thank you so much for taking my questions. I appreciate it.
Great to meet you.
Yeah, of course. Of course.
All right. Let's bring a Moga on stage. We're prioritizing the folks who are going to do video here because it's just fun to see people.
Hey, guys.
Hey, what's up, Moga?
Nice to see you again, Ryan.
Yeah,
nice to meet you, lady. All right. So I have 2 questions. First one is, how do funds come up with their investment hypothesis, thesis? What are the different influencers while coming up with your investment thesis? And second part question is, what happens after you, Matchstick Ventures, specifically fund or invest in a team? How frequently do you interact with the team? What happens after the check clears? How often are you interfacing with them, jamming with them? Yeah.
Yeah.
Well, I thought you were going to ask how we come up with this amazing name for our fund.
Oh, yes,
No,
exactly.
just kidding.
You're setting fire to startups, like you're getting them the first flames, right? Like lighting the candle so that the rocket can take off.
Startup strike. There you go.
Sometimes we think we bring the kinetic energy to their potential energy, but that's like
that's a really good one.
Just make that
That's my weird nerdy side. Yeah. Maybe I'll take the first one here, which is, I mean, I think the fund, like when a fund raises capital to invest in startups, like they're playing on a strategic advantage that they have. Just like a startup should play off start a company because you have some sort of insight or strategic advantage. You know, if we didn't have a strong point of view or some strategic advantage, you know, why are we doing what we're doing? And for us, that was just believing a lot in these non-coastal markets and just seeing the caliber of entrepreneur in them and the lack of funding, local funding options for them. All the way back in 2015, and just realizing like this is an incredible opportunity to work with some of the best entrepreneurs who are overlooked and to grow our communities and ecosystems. And we just felt like, why should you have to move to San Francisco if you want to start a company? You know, we have amazing people here anyways.
And burn a lot of cash.
You know, and it's like, that was an advantage that Ryan and I had because we had started things like Twin Cities Startup Week. We knew a lot of people in the community. We felt like, hey, we know this is a good opportunity. And so we want to capitalize on it. And frankly, I think when we started Matchstick, like that was a little bit contrarian to say, hey, there's going to be great companies built in the middle of the country. Now that seems less contrarian, but it's still a little, you know, people still think we're a little bit oddballs. Like we're like not interested in the San Francisco startup, but that's fine. We'll keep doing what we want to do. So, you know, long story short, using our example, like I think every fund raises around some unique competitive advantage they think they have in the market. And certainly that's what we focused on.
Yeah. And your second question around like, how do we help, I think is also one of the strategies, you know, that you raise funds off of, right? So both Natty and I are former entrepreneurs, backgrounds with Techstars, et cetera. So we feel like we can really help startups through that seed phase, right? Like we like to enter into a company, invest very early, support them through that phase. And then once they go into the growth phase, you know, we bring in experts who are great at, you know, that phase of growth as well. So, you know, for Natty and I, what does that look like in a typical investment? You know, that's regular calls with our founders of us basically working on their behalf, right? In support role for them. With this new fund, we're launching a network of mentors called our Matchstick Strikers, who are, you know, mentors, domain experts, corporate development folks who are raising their hands, who want to help, right? And that we can connect our founders with to help them through that phase. You know, and we are constantly, you know, kind of out in the market, meeting with other funds, other biz dev opportunities on behalf of our company. So when they do go to raise, you know, subsequent rounds, we have a host of, you know, potential follow-on investors for them. So we are very much you know, I mean, VC is a service organization, right? Like we invest a commodity and cash into companies, and then we, you know, try to provide service on top of that. And so we try to really focus on, you know, being founder first in supporting our founders from day one and helping them through that, you know, seed phase.
It almost sounds like a derivative of Techstars, but with a different spin, right? With the mentors, the match.
We definitely have Techstars DNA. You know,
there's some.
Yeah, it has a lot of Techstars DNA.
Yeah, awesome, cool.
Thanks,
Moga.
I want to pick up. Shia asked a question, and apologies if I pronounce your name wrong. That we actually hadn't gotten to, which was, would you say VCs are more interested in companies that have teams versus a one-person startup? And I'd say like this is. I think in general, VCs prefer teams just because there's a lot that needs to get done in a startup and it's hard and you want to have someone to be along the ride with you as a founder, but certainly not a rule. It's just more of, you know, I think VCs understand that sometimes there isn't a co-founder in a company, but they will want to know what your plans are around adding to the team and making sure that you're someone who does actually want to bring people on board. You can work well with other people. And it's just sort of the way that the company foundation happened, just there wasn't a co-founder there. So there needs to be a good story around it. And frankly, some of the biggest companies that we've ever seen were founded by solo founders, Oracle, Facebook, et cetera. So totally possible to build a big company without founders, but I think you just need a good story around it. And ideally you would have a sense of like, who would you hire and who are you going to put in certain key roles when you meet with the VC, because they're going to want to know that, because you just can't build a big company by yourself. But certainly don't like go get a co-founder just for the sake of, meeting with VCs, because that's a recipe for disaster. And actually we have some other talks this week that we're doing around like those co-founder dynamics. I think it's tomorrow, one called Building a Company from the Inside Out, if you want to learn some good strategies around building great co-founder and inner team relationships as well. So check that out.
Just a time check here. I think we're scheduled till 1:45. So we've got about 5 more minutes.
Oh, great. Let's do some rapid fire stuff here.
Yeah, we got some more here.
All right, let's see. Yeah, we'll get through everything here.
Is this being recorded? Yeah, this is being recorded. There's some questions there. How should founder salaries be handled in pre-seed rounds?
Yeah, obviously it depends how much money you raise, but I think what my main advice is you should take the minimum amount you need to live and not be worried about money. Because if your brain is focused on, oh my God, how am I going to make rent? I can't feed my kids. My ailing parent, like I need to provide something for them, whatever it is, like you're just not going to be as good of an entrepreneur. So figure out what that lowest number you need is to sort of like live, add a little bit on top of it. And ideally that's like what you would take. The reality is that doesn't need to be equal across the founding team too. You might recognize one of your co-founders just has a higher need. Maybe they have kids and you don't, or something like that. And I think that that's okay. It doesn't need to be equal. What you want to do is make that money stretch as long as possible, so you have as many shots to prove out the hypotheses at that pre-seed round while being as focused on the business as you possibly can. So hopefully that's helpful.
Jerry's asking about our typical process for making an investment decisions, number of meetings, virtual, in person, and how long does it take? So I can take this one. I know for Matchstick, like we move pretty quick on stuff when we get excited about it, or we I guess really kind of come to a decision on investment. But really the process is a series of interactions, right? And it's more and more virtual these days. It was exclusively virtual for quite a few days, but now it's getting to be more of a hybrid approach. Typically it's a virtual, kind of first meeting. Someone reaches out, we get a referral, someone, connects with us online, a lot of founder referrals, et cetera, in our market, or people, literally just reach out directly to us. We'll respond back, but, typically kind of like a meet and greet, quick, virtual connection. And then things start to, be a series of back and forth between the two of us and that founder. For Matchstick in particular, we start to dig in more and more about the why of the company, business model of that company, market opportunity. And then there's, a series of meetings with one partner, other partner, both partners, reference checks. So it sounds like a lot, but it actually can go pretty quick when you get into the rhythm of it. And then ultimately in the Matchstick team, like we make decisions together. So Natty can veto, or I can, or not. But usually by the time we get to decision time, it's a lot of the questions have been answered by either partner. So I'd say probably 3 to 4 meetings, and can take. I think we've made decisions in less than a week on some companies, but I would say probably more typically in like the 2 to 3 week range.
Seisha, thanks for the tip there. Beautiful name. Let's try to do the last 2 questions here. So Mike, Louis, we have a question around new hires. How much cap table would you expect? And is this Sai? We're going to get to you as the last question here too. But Louis' question is, how much cap table would you expect, if any, to be allocated to early hires? Usually what happens is when you raise your first round of funding, you're going to allocate about 10 to 20% of the company in your option pool, and you'll use that for early hires.